So let's take some questions. I like questions. What do you guys got? Hey everybody, it's Dave. I'm back with another Maker Zone. People get good value out of this, so thanks for all your comments and for the questions you ask over the various channels. You can see them in the LinkedIn post. Today I'm super honored to be here together with David Hamilton. He's the CEO and founder of EYs, and actually it's Fintech before there was Fintech, and also together with everybody's favorite enterprise architect turned entrepreneur Mikey Ruprecht. We launched Ynome last year together. So I want to basically talk about new asset consolidation, one of the top trends in fintech. And Dave, do you want to maybe introduce yourself a little bit?
Sure. David Hamilton, CEO, not founder of EYs, but thank you very much. I'll take the credit for it anyway. I've been in the financial services technology market now for about 20 years, which feels like a long time. It certainly feels like that a lot of younger people are getting credit for fintech, but I was certainly involved, back in the late 1980s, where I was working a lot in financial services technology, providing it to credit unions and so on. In fact, I got involved in the financial services tech vendor space when I was working for a credit union league in Australia. We were finding it very, very difficult to compete with our core banking platform with the larger banks. As the larger banks added new products and services, more complex mortgages, more complex deposit products, our aging core banking systems were really struggling to keep up, and our product managers were struggling to keep up with the value propositions in the market. So we launched a 2-year, 32 system study looking for a new core banking platform. We eventually selected one from the US, provided by a company called Fiserv, which is one of the big fintech companies globally. And at that point, actually left the credit union marketplace and actually went to work for Fiserv, and had a 12 or so year career there before moving across to SunGard, which is another very big financial services tech firm where I ran all of the banking division globally. And then towards the back end of 2012, early part of 2013, I left SunGard and started to work for a lot more vertically oriented, much smaller financial services tech firms like EYs, for example, where I've been now the CEO for just over 3 years.
It's amazing because a lot of people think of fintech as a millennial thing, right? And being against banking, but what you're talking about is coming from the core systems that operate banking since the 80s, which frankly, that's scary, right? I mean, most of the guys who worked for me weren't born yet. We were.
Right, we definitely were.
Yeah. So how did that work? How did you transition, and did you find it a comfortable transition from, the original core system, SunGard, Fiserv, into now what's really the new school fintech world?
Yeah, I mean, I think the thing about core banking systems is that they've obviously evolved over time, and they've become very monolithical. So, back in my time with Fiserv, back at my time with SunGard, when all you have is a hammer, everything looks like a nail, right? So you wanted to fix everything inside the core banking platform. And I think what everybody's realizing now is certainly the trend we see in core banking is de-scoping core banking back to a book of record, account processing, make sure it's scalable, reliable, robust, bulletproof, and it's API driven. And then all of the innovation around the core is happening both from, to some extent, those core vendors, the Fiservs, the SunGards, the Mises of this world, but also by a plethora of startup fintech firms that are providing value around that core now, in the middle and the front office and in the digital channel space.
This is what I wanted to talk about today, is this theory of asset consolidation that is now one of the hottest trends. So we had robo-advisory, which was a hot trend for a few years. We had peer-to-peer lending. The whole hype around artificial intelligence and blockchain we've covered in previous episodes. It's still very much the jour de rage.
Right.
But asset consolidation sounds boring, but what I'm seeing is that it's one of the hottest potentials, the biggest potentials that we have, besides just getting gamification, social media right. Can you talk to us about asset consolidation and what EYs actually does with this?
Yeah, so EYs was founded in Australia back in 2000. Our first client, Westpac in Australia, which is one of the big four, they implemented the system in 2001. And back then, it was really designed to create, if you like, a balance sheet view for the end consumer. So when I logged on to internet banking, I could see all the things that I did with Westpac, but then I could see my entire balance sheet, everything that I did with every financial services provider. And that came at a very interesting time in Australia where we were starting to see more and more competition from the non-bank financial services providers. So we had companies like Aussie Home Loans and RAMS, which are very successful non-bank mortgage originators. They were originating mortgages, packaging them up, selling them into the mortgage-backed securities market, and not taking them on balance sheet. And what happened is, once the consumer started to be able to access these non-bank services at a much, much lower price point, then all of a sudden consumers started to fragment their relationships. So we went from consumers having a primary banking relationship with maybe one, perhaps two banks, to all of a sudden having 16 to 23 different financial services relationships.
Wow.
When I add up all the financial services relationships that I have in my household, it's 27.
Including insurance.
Insurance, credit cards, mortgages, loans, leases, bank accounts for debit, Maestro cards and those sorts of things. So I have, as an average consumer, a fairly complex set of relationships to manage now. So we've been aggregating or consolidating assets now for 16 years, and we've certainly seen a number of different trends, but it all started with this need to see a more holistic view of my relationship as a consumer. I think it's evolved now, but certainly that was the genesis of it.
Well, has it, or is it getting worse? I mean, I must have, on this one phone, I must have 6 different ways to pay.
Right.
For something.
I think it's getting worse. It's not getting worse. It's becoming more atomic. I think the number of different services that consumers have access to now has grown exponentially.
It's basically the effect of the latest Fintech wave. Basically, you get more atomic services. So, yeah, it's new things that you get which weren't banking before. I mean, now you technically should also have your crowdfunding stuff in there and anything else. So it's a lot more.
It's a lot more, and the adoption rates are a lot more faster. Yeah. If you think about how long it took for the debit card market to reach 100 million users versus how long it took Facebook to reach 100 million users.
Or Apple Pay for
Or Apple Pay, for example, right? So technology distribution has meant an exponential climb in the rate of adoption as well. How fast can we reach 100 million consumers is now measured very, very quickly. It's measured in months rather than decades, right?
But something we talked about earlier, before you can see we were whiteboarding, and something about, we had this great analogy where our children, right, they have, if you envision their interests of their life, including their finances as one potential sub-interest, as a circle or a pie chart, there's a little tiny slice which is the money part, right, the finance. And over your life, that money part tends to creep out and grow.
Right.
And when you're a wealthy person, it also expands in its complexity. So an affluent, wealthy person also has investments in real estate, private equity funds, alternative energy investments, potentially his business, pension funds. How does a person start to bring that all together besides Excel?
Right. Yeah. I mean, that's a great question, and you're absolutely right. In the high net worth and ultra high net worth segment, cash and what we call online financial instruments is one part of the overall wealth picture. Alternative investments, property, but also passion investments, classic cars, wine, gold, art. A lot of passion investments now becoming an increasingly larger portion of overall wealth. And we now have the ability through indices to be able to track the performance over time of those assets as well. So it's not like I'm buying a big wine collection for the sake of buying a big wine collection. I do expect in many instances to see a return on that investment as well. And you're right, we go through this, my children, for example, they invest a lot, interestingly enough, in music royalties. My daughter's a big acquirer of music royalties. And she has some cash, but she likes to put that cash to work in a bunch of different areas that she finds interesting. And I think in the ultra high net worth market we call that passion investment, but I think I'd use that same term down at my children
pocket money,
as well.
yeah.
Exactly.
It's pocket money spending.
So I'm wondering where that all goes, and what's the value prop of an EY's or some of your competitors? This asset consolidation trend driven by Fintech, so to speak, which isn't really Fintech, is it? It came from a long history before that.
Sure.
What do consumers see differently today, and what can they start to do with these things that they couldn't do a few years ago?
Yeah, I think for each stakeholder, the motivation is slightly different. So from a Fintech standpoint, from a technology company that's looking to grab a user population through an app, the motivation is quite simple, right? How do I grow my user base and how do I create a profitable business? But what I'm doing in those apps, different to, I think, what we've done in the past, is those apps are data-driven. These are absolutely data-driven revenue models and data-driven user engagement models. So one example is, for example, I could have an Atomic app, and all that app does is help analyze where I waste money every year on online subscriptions to newspapers. I subscribe to 4 or 5 different newspapers. I really only read 1 or 2 a month, and I'm wasting money on annual subscriptions that I've forgotten that I signed up for 12 or 18 months, 2 years ago. So we can have very narrowly focused apps, mobile apps, that are using data to create value for a very specific service. From the consumer standpoint, asset consolidation is interesting, but it becomes really interesting when the service provider tells them something they didn't know. Okay, and adds real value.
That's like
with the data.
It's like the old story of all the fintechs and all the digital engagement models. If you give something back that they don't know,
right,
that's the value that you create. It's not having all that data and creating a large number of whatever columns and rows with numbers in it. It's just literally doing something on top of it.
But there's two things in what you said that I think are very important to pause on. One is that, and you said this earlier, you're in the business not of making apps and new things like a TransferWise for consumers, but actually you're in the money of data. Right?
Correct.
You're in the business of
we're in the
data.
EY's is in the business of data. We don't want to be an app developer. We think our clients are much better at that than we are. You know, most of the clients that we do business with are the large financial service providers and the well-funded startups, and they specialize in that app development, that UX, that customer engagement. What we want to do is be the underlying platform to drive data into, as I said before, their data-driven revenue and business.
So I have to vote for this. I have to vote for this strategy right here, because what I'm still seeing is people blundering on as if it's still 2011. So if you're a consultant watching this, if you're a finance professional, if you're working in innovation, don't try to go and produce new apps. With Giorgio sitting across in the room, what we've already learned is that people won't download new apps in 2017. There's a very high threshold to do it. And I think being in the business of the underlying tech, of the underlying experience of having all your data there, but not actually trying to provide the end experience, is a better way for you to approach finance providers, like big banks.
Correct, and you know the market that we're trying to enable. You know, if I think about Europe, I think the World Economic Forum two years ago estimated that by 2020 there will be a €1 trillion a year opportunity in terms of the economic value of personal data. Okay, so personal data is the new oil, if you like. It's a new asset class that businesses will look to create revenue from. And we're in the business of enabling that personal data. We want to take a very consumer-centered view of that. We want to make sure that the consumers maintain sovereignty over their data, and they can choose who they share that data with and for what purpose. But we absolutely want to put the customer at the center of that data. We want to enable them to share that data, and more importantly, we want them to get value back from that data as well.
That's, I think, one of the, I mean, it's also an old theme, but it's a very central theme. You own the data. You take that data, figuratively speaking, to someone and ask them to do something with it in terms of, can you provide me a service to say whether I'm being screwed over by my trader or something like that, and then you take it back again. So it's a different thing, and it plays exactly to that theme that you reduce core banking or into really the thing that you need to do, open up the APIs, and have all that surplus of data that you need in addition to that at your premise, at your command, and then you go somewhere and take it.
This was the second main theme, what you're getting at now around what you said earlier. So the first one was we're in the business of data protection and provision, not the business of providing sexy UX experiences to clients. But the second piece was, what are the new value propositions around data? So we know from a wealth manager perspective globally, the average clients have 3 to 5 major banks working for them, in addition to hedge funds and private investors. And that's in the high net worth space before you get into that ultra mega rich people space where they have also their own former investment bankers working for them, as family officers or wealth managers. So like, you know, as an average person on the street, if you've got 4 or 5 different banks and relationships, and you can put that all on one page, that's interesting, but that's not necessarily enough to get me to join another bank or to join another service. So what are some of the new value propositions you're seeing in terms of having all that data in one place? Where do we go from here?
Well, so it's an interesting point. Go back to that use case, right? So I'm an average consumer. I've got 4 or 5 main relationships that I have. Putting that asset consolidation layer the pretty pie charts and bar charts in front into a portal on top of all of that doesn't necessarily lead to changing buying behavior. It's not going to force or compel a user to move a credit card from one institution over to you. Yeah. But most of the clients that we do business with, that's not their expectation. Okay? They don't necessarily expect a lot of switching to occur. But what they want to do, for every new buying decision that the client is faced with, they want to be the first place they come to. So they want to be the clearinghouse, if you like. They want to position themselves between the consumer and all of the institutions that the consumer does business with. Not because they expect the consumer to switch an existing relationship from one institution to them, but they want to be at the center of every new buying decision. And they recognize that not everything that the customer wants to buy going forward is going to come off their balance sheet. It may come through a partnership. It may come through a reseller agreement. It may come through a lead gen agreement. But they want to know about that purchasing decision every time so they can decide what to do with it.
So it's a funny dynamic, right? So the banks are all shifting towards asset consolidation, right? And there's some regulation moving us all in that direction. But we won't go down into that deep technical right now. But what happens when the banks start to disrupt each other, right? So we're describing one where we say lead bank A wants to have a consolidation picture first and wants to advise strategically over the portfolio or assets of a client across the 5 banks and take away the power of the others.
Right.
Isn't that what everyone's scared of Google, Amazon, Facebook, Microsoft doing?
Yeah, yeah.
It's the same model basically. You're at the entry of every purchase decision, as you said. So basically, you at least know it, and that's the information that you have. That's your advantage.
Yeah.
Even if you don't do the business behind it.
Correct. And I think there is a clear path for a lot of banks, if you like. Do I become a balance sheet provider, a utility of balance sheet services that are then wholesaled out to somebody in a front office, or do I become the customer engagement bank, where I lead the engagement, and yes, some of that portfolio is managed on my balance sheet, other parts of the portfolio is served out to a bunch of partners.
But you're giving the advice.
I'm giving the advice.
And by giving the advice, you take the lead, isn't it?
Correct.
It's kind of like a lead on the deals in investment banks, right?
Yep.
There's one lead underwriter on every deal, or 2, and then there's a syndication of others who help support the deal, but the lead is where you want to be.
Yeah, and let's be clear, I mean, the banks still maintain an incredibly valuable place in the value chain, right? I mean, they are the regulated entity. You know, not everybody can afford to be or wants to be a regulated financial services business. So there are many banks that are positioning themselves, particularly in the US, really as, you know, balance sheet as a service. You know, I'm going to black box my bank and provide that through a utility wall socket, really to anybody who wants to offer regulated banking services in addition to whatever it is they do in their app, right? So I can be a TransferWise that enables, you know, customers to do X, Y, and Z, but the moment I want to provide a regulated banking service, I don't necessarily need to be a regulated bank to do that. I can plug into a partner. And that's one valid strategy for banking going forward.
That's one.
Equally, banks, particularly the large banks, you know, like UBS, for example, that have got very trusted relationships with their clients, they will want to position themselves as that trusted advisor. And, you know, I still think we live in a day and age where consumers and affluent, high net worth individuals do trust their financial services arms and brands to do better with their money than a Google or an Amazon or a Microsoft. I know I would, right? Yeah. Because that's the business you guys are in.
I mean, I want people to get...
That's the know-how that you have. Yeah.
I want people to get... The first feedback I get on these podcasts is some of my personal friends who listen to this have said they can't hang with the fintechy and it's over their heads, right? And I want people to be able to hang with this. I mean, what you're seeing here in this is the future of what you're consuming on a daily basis, whether you're a wealthy person or you're a retail banking consumer. It's kind of where the industry is moving to, is that you'll have a full picture of all your finances on your iPhone, on your smartphone. And the second thing is, I think there's going to be new value propositions coming out of that we couldn't predict.
Right.
Like 10 years ago, when we were all surfing the internet for the weather report, we didn't know we could also now have Google Flights and Airbnb and Uber, and we would have our computer in our pocket at all times. So what I'm really looking to do is create new value propositions around this, and specifically around wealth management, since that's where I'm coming from. So what are a couple of those new value props that you've seen and where we should be headed?
Yeah, so on the wealth management side, we see a lot of asset consolidation. Again, think about asset consolidation more of a data aggregation service than the pretty screen on the top, right? So if I'm aggregating all of this data into a platform, how I use that data is now the subject of literally thousands and thousands of discussions, right? Because I can take that data and apply it to a number of different use cases. I was sitting in Geneva with a multifamily office just a few weeks back, and their use case is very clear and highly valuable. They take that consolidated transactional data from things like equities trading. They reconcile those equity trades that the individual investor was doing against the market data and find gaps of differentiation where perhaps the market was trading lower than the price point that the investor paid, and they expose and uncover a bunch of hidden fees and behavior in the brokerage side, and they can then make that client aware of where they're potentially overpaying for services relative to the market.
Mm-hmm.
So the application...
A fascinating value proposition.
Yeah,
because it's real value back to the consumer.
Exactly.
Immediately.
I mean, it's leakage, right? I mean, nobody wants monetary leakage, right? You spend so much time and work so hard to create wealth, the last thing you want to do is destroy it through fee overages and so on. So it's an incredibly valuable service. But that's just one of literally thousands of use cases that you could apply financial services data to, and it's wealth, it's consumer. It's, with my daughter, you and I were talking about this earlier on. The interesting thing about behavior, right? Financial services is really at the core of all valuable and material services. Okay, I always say to my children, look, if you're not paying for the product, you are the product, right? You've got to be cautious of stuff you're not paying for, right?
Yeah.
If you're at WhatsApp, right?
WhatsApp,
yeah,
Facebook, you name it.
You name
Google,
it, right? You're
product.
giving stuff away, you are the product, right? Any meaningful service that adds value, you will pay for, okay? iTunes is a great example. We sat down and analysed my daughter's iTunes spend a while back, and we found she has no real interest in owning the content that she buys from iTunes. And she could save quite a lot of money by shifting to Spotify. She can save quite a lot of money from shifting her, her video, TV, movie viewing from iTunes to Netflix. And that provides really valuable service for her. And that doesn't start by analysing iTunes data. That starts by analysing statement data. Mm-hmm. How much is she spending every month on iTunes, and is she getting the value that she really needs from that money? So even a 16-year-old is looking to make her money work harder for her, the same way that a high net worth individual is.
So this is kind of my call to action out of this episode or podcast. If you made it this far and you're still hanging, I've got to say that the thing about asset consolidation is not about just putting 4 bank accounts on one paper.
And producing a pie chart.
And a pie chart.
No.
It is definitely about new value propositions,
right.
Because there's new value you can create
Mm-hmm.
by telling people where they're wasting money,
right.
where they should be spending their time or their
Mm-hmm.
money more effectively,
right.
by looking across the big picture instead of being focused on one small piece of the picture.
It's an enabler. Having the aggregate
Exactly.
is an enabler,
Right.
but combining the aggregate with capabilities and know-how services that you have as a bank, as an FA, as, I don't know, that makes the thing interesting, because just, as I said before, just having a bunch of numbers and
right.
is not helping me as a client. I want to know, do I spend too much on iTunes, or as a more wealthy guy, do I spend too much on my trading or things like that?
Exactly.
Tell me something I don't know.
And then I'll come back to you.
And then I come back to you, and that's also like the platform play you mentioned earlier.
Mm-hmm.
If you position yourself on the entrance of any purchase decision, the aggregate is a vehicle to get there.
Correct.
That's one way to get there. It's basically, okay, we know all about you, basically. If you go through us, we can give you a thumbs up or thumbs down, whatever you're planning to do.
2 specific things about this, and then you have the last word because you're our guest today. I've spoken with clients, affluent clients, more wealthy clients, and they've all always said the same thing. Just give me one picture of how I'm actually doing. At all times, I want that one picture, and I don't care who gives it to me, but that's who I'll be the most loyal to, is who gives me that picture. That speaks for asset consolidation. And the second piece is, we had a group of client advisors over here the other day, and they said 80 to 90% of our time, we do not talk about portfolios and investments and money. We talk about other things that are important to the clients that we work with, because that's what really drives them. Passion investments, emotional investments that they make that are outside the normal strict interpretation of stocks and bonds. And therefore, I see an enormous potential in this, bigger than the potential of robo-advisory 5 years ago, actually. And I don't think people are really taking it serious enough.
So I agree. I mean, I think what you just mentioned there is key. For almost everybody on the planet, money is not the thing. Money is an enabler. We talked about data being an enabler. Money is an enabler. Whether you're a 16-year-old, a 46-year-old, or a 76-year-old, money is about how you get to do the things that you want to do. The conversation ought to be around what are the things that you want to do and how do we get you there versus how much do you have today, right? About where do you want to go and how do we get you there. Data is an enabler of that, money is an enabler of that, and those two things go hand in hand. And that's why I think banks have a really critical role to play going forward. The disruption is the disruption, but banks are always going to be there, I think.
I have to make a prediction. This is one of the smartest guys in the room that we can find on not only asset consolidation, but in my mind also fintech. And I think when you exit your billion for 100 to 200 million in a few years, I'm going to be cheering you on and also severely jealous that you actually converted this into a real business model and did so well with it. So thank you so much for giving us free wisdom today.
Great time. Thank you very much. Appreciate it. Thanks again.
So let's take some questions. I like questions. What do you guys got?